The family of YieldMax ETFs has been all the hype as of lately, and for good reason. But with some of them having distribution rates over 70%, the questions a lot of investors are having are these ETFs too good to be true? Well, stick around until the end of this video because we're going to uncover the actual truth about this style of ETF, and also I'm going to show you the exact math and method of how any everyday investor could invest only $5,000 into one of these new covered call style ETFs and generate around $168 every single month. Yes, you heard me right, over $150 in dividends from just $5,000 invested. But like I said, stick around because we have a lot to go through. Right after you, please drop a like in this video and subscribe for more future content like this. So heading right over to the YieldMax ETF website. If you're not familiar with any of these covered call style option ETFs yet, I'm probably about to blow your mind. So YieldMax ETFs has a basket of different ETFs that track either ETFs or single stocks. Like for example, this ETF tracks Tesla. This one tracks Apple, and this one tracks NVDIY, which is the one we're going to be going over in this video. They even have other new ones that have just been launched. This one tracks Amazon, for example, Facebook, Google, and even Netflix. Now, as of recently, there's even one that tracks Microsoft, which I definitely have my eyes on. But also, yes, your eyes are correct. You are seeing a 58.44% distribution rate for OARK. TSLY has a 70.59% distribution rate, and NVDIY has a 40.81%, which is the ETF we're looking into today. So looking a little bit deeper into the NVDIY, the YieldMax NVIDIA Option Income Strategy, it says Fund Overview. The YieldMax NVDIY Option Income Strategy, ETF or NVDIY, is an actively managed fund that seeks to generate monthly income by selling and writing call options on NVIDIA. NVDIY pursues a strategy that aims to harvest compelling yields while retaining cap participation in the price gains of NVIDIA. But not wasting any time, let's get right into the literature of this ETF and learn more about it and how it works. So it says Principal Investment Strategies. This fund is an actively managed exchange-traded fund that seeks current income while maintaining the opportunity for exposure to share price, i.e. price returns, of common stock in NVIDIA Corporation, subject to a limit on potential investment gains. The fund will seek to employ an investment strategy as it relates to NVIDIA regardless of whether there are periods of adverse market, economic, or other conditions. So no matter what happens, they're going to stick with the strategy. Now, as further described, this is how it works. Exposure to the share price of NVIDIA returns, current income from the option premiums, and a limit on the fund's participation in gains, if any, of the share price. Now, more about how it works. The fund strategy will cap its potential gains in NVIDIA shares if they increase in value, because of course ETF uses a covered call strategy. The fund strategy is subject to potential losses if NVIDIA shares decrease in value, which may not be offset by the income received by the fund. So even though this fund generates a boatload of premium, it doesn't mean that the fund still can't lose money, and of course investors in this fund can't lose money. This fund does not invest directly in NVIDIA. Fund shareholders are not entitled to dividends. So the way that NVDIY works and the way that the YieldMax funds work in general, they use something called a synthetic covered call strategy. So a traditional covered call strategy is a strategy that many of you are probably already familiar with. But it's a strategy where a fund sells a call option on underlying securities that it owns. So if you own 100 shares in NVIDIA, you can sell a covered call on the shares because you own the shares, and then of course selling the call will earn you the premium. A synthetic covered call strategy is similar to the traditional covered call strategy, in that the investor sells a call option that is based on the value of the underlying security. But however, with a synthetic covered call strategy, the investor of the fund does not own the underlying security. It rather seeks to synthetically replicate it, 100% of the price movements of the underlying security through the use of various investment instruments. So now that we understand a little bit more about how the YieldMax ETFs work and what really consists of their strategy, looking into NVDIY, the specific YieldMax ETF that we're going through in this video, you can see that so far as price return goes, this ETF is actually up 10.11%. And just 1 second, because that's not even dividends included. Some more important aspects of this ETF is of course that the expense ratio is massive, at almost an entire percent. Now the dividend frequency for this ETF and for all the YieldMax ETFs is monthly, which is of course why I think these YieldMax ETFs are so popular, because they can generate a boatload of money for investors on a monthly basis. Now of course, obviously this ETF has not been around for all that long, which is sort of a bummer because for long-term dividend growth investors like myself that are always interested in adding new ETFs, new stocks to their portfolio, I love to see historical performance. And even though historical performance never guarantees future performance, it's still nice to have a track record of how things have went historically. But as we can see, this ETF has only been around since around May. Now to get to the fun part, looking at NVDIY's dividends that have been paid out since the fund's inception, looking at the past few dividends. So there's only been 3 dividends paid so far. But all the way back in June, a 75-cent dividend was paid. In July, 96-cent dividend. and just as of recently in August, an 81-cent per share dividend. Now, just to put things into perspective, this stock is around $23, $24 per share right now. So if you're earning over 75 cents on a monthly basis, this of course in theory means, just in theory, if the payouts were to continue like this, you could have your entire investment paid off from the dividends that it pays in just a matter of 12 to 20 months. Now, of course, that being said, like I mentioned earlier, this ETF as well as pretty much all the YieldMax ETFs have not been around for all that long, so take everything with a grain of salt. And what I'm doing personally is buying a few shares of all these different ETFs so I can participate in what's going on, but still not be overextended personally or overstressed about what's going on. Now, what's absolutely crazy is the total return when it comes to these YieldMax ETFs. And of course, some of them are better than others. And also, side note, total return means price return plus dividends included. But for NVDIY, the total return over the last month is around 0.51%, but then the year-to-date time frame, which is the longest time frame we have to go off of, because of course this ETF hasn't been around for that long. But year-to-date, this ETF has returned 34.41%. Now, to be honest, as a dividend growth investor, I'm absolutely ecstatic about a 8% to probably a 15% return on a yearly basis. But in just 106 days, NVDIY has returned 34.41%. Which brings me to my next point. You saw the title of the video. I suggest $5,000 per month invested into NVDIY could generate a massive amount, over $150 a month in dividends. So the way I got to this number is the following. We have to see how many shares of NVDIY we can afford for $5,000. Now, since NVDIY is around $23.40 per share, we would be able to buy around 214 shares of NVDIY. Now, the last paid dividend, which again, the dividends have fluctuated, but let's just go off of the last one for this example. The last paid dividend from NVDIY was 81 cents per share. Now, that means if an investor invested $5,000 into NVDIY in that month specifically, they would be able to generate around $173 in dividends. Now, what's absolutely crazy, if you were to multiply that by 12, and look at the yearly payout amount, and again, these numbers can completely change because as we learned earlier, the YieldMax cover call strategy is going to most likely remain sort of volatile because a lot of the underlying holdings that they use can definitely move around a lot in price. But just for fun, over a 12-month span, going off of our math, an investor could earn $2,076 per year in dividends with just $5,000 invested, which means an investor could be almost all the way paid back from their investment in just around 2.5 years. So I know what you might be thinking, well, why doesn't every income-focused investor ever just invest all their money into these ETFs, get paid a boatload on a monthly basis, and move on? Well, the obvious answer, of course, is that these ETFs aren't all necessarily going to continue to outperform the overall market. Depending on what happens in the market, these ETFs could, of course, lower the distributions and could, of course, even see massive price decay over time. But that being said, these ETFs are definitely very interesting, and I implore all of you to look deeper into them. But now I want to hear from you guys down below. Are the options for your income, the YieldMax ETFs, something that you would possibly have in your portfolios? And if for whatever reason you were only able to hold on to one of them, which one would you hold and why? If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.